Well, very good. I see we are at the top of the hour here, so maybe we'll go ahead and kick it off.
Sure.
For those of you watching or tuning in, we're excited to have you here. And Scott Oeth and special guest John Nersesian with us. Very happy to have John back again. He's been good enough to do a couple of these sessions with us. First joining us on a panel where we talked about state residency planning and thinking about taxes and retirement and domicile and the whole myriad of issues that go along with that. And that was a great session. We have that one recorded and available. And we spoke not too long ago about specifically executive compensation and equity-based compensation for executives. And we talked about the different types of programs that are commonly out there between restricted stock and restricted stock units and stock options and a couple different flavors there, and non-qualified deferred compensation plans. And that was a very good overview, I think. That was a great conversation. And for those of you who are tuning in, I would refer you back to that one. We also have that as a recorded session because we have a lot that we are going to try and cover today, and no way are we going to get into it all, but we're probably going to move fairly quickly. And a lot of the more explanatory and the baseline stuff we did cover in that last session in terms of what it is we're talking about here, these different types of plans. And I think it's also important to note that not everything that we talk about is applicable to every executive, right, John? I mean, each of these companies have different packages and there's different plans for different folks. And so I really hope those of you listening, find something of value. And I think we'll try and talk about the things that are broadly applicable or more commonly available. And then there's more niche or specialty options. And it's always fun. Some of the strategies that are the real sort of whiz bang ones that are exciting to talk about. I found in my experience, I don't know what you, John, often you talk about them, they're interesting, you lay them out on paper, you show the numbers, but it seems like more often than not, you kind of lean towards the simple and more basic strategies. But
I like that approach, Scott. I like the idea. I think one of our roles as advisors to these clients is to really help them understand what their options are. So, and I kind of like to make decisions that way as well. If I'm looking to buy a home, I don't want to just go look at one property. I want to understand what are other properties that I might be interested in, those that are maybe more expensive or less expensive, smaller or larger. And then maybe sometimes that just simply reconfirms the approach that I had originally thought about. And so I kind of like the latitude or the opportunity to look at a matrix of options. And we're going to go through that today. What are the different planning options? And then I always like to say, wait a minute, first things first, maybe we start with the most fundamental and only when appropriate or, relevant, right, we move up scale from there. So.
Yeah. Well, I think that's great. I'm looking forward to it. Maybe to kind of finish the introduction, I should say also, by way of disclaimer, our compliance department always wants us to throw out that John is the head of advisor education with PIMCO, one of the world's largest asset managers. I'm with Cahill Financial Advisors. There's no business relationship. I'm not owned by PIMCO, vice versa. We're completely independent organizations coming together to share ideas and advice here. And again, everything that we're talking about here is general informational purposes. No one should take this as the definitive answer or direction on their specific situation. Seek your own professional advice, do your own research and homework, certainly in each case. And I mentioned John's been with us before, but I should say, it's your head of advisor education. Is that your correct title, John?
Yeah, that's what I do at PIMCO. So we work with great professionals like you, Scott, and others around the country to deliver advice and education that hopefully allows you to provide even greater counsel to the clients that you serve. Executive compensation obviously is one, but one of many topics that we're often asked to comment on. And so I know in our first call, Scott, what we had done as a reminder to those on the line with us, we had done an overview, kind of the fundamentals of equity compensation. And what we did was we talked a little bit about the two most common forms of equity compensation, restricted stock and employee stock options. And we gave examples of how these two different types of awards worked. We talked about vesting schedules. We talked about the exercise strategy. We talked a little bit about the tax ramifications. And so we really provided, if you will, a very fundamental overview of the basic forms of equity compensation. What we're going to dive into today are some of the more advanced planning strategies. Now that you know what you own, the question is, what do you do with it? And we're going to address some of those different alternatives. I like, as we were discussing a moment ago, Scott, I like laying out a matrix. And I like not necessarily embracing a strategy because it sounds great. I like to start first with what is it you're trying to accomplish? What is it that the investor is, what is their goal or what is their concern? So is my primary goal to reduce the taxes of the award I've received? Is it to improve my liquidity because I need cash to reinvest in a business or buy another home? Am I looking to simply reduce the downside, right? Or am I looking to maximize the value? Now, for many clients, of course, I want all the above. Help me accomplish all of these simultaneously, Scott.
Goldilocks.
But I'm going to try to introduce these different strategies or solutions, not in the abstract, but in terms of what problem they help a client solve, if that makes any sense.
I think that's great. You know, oftentimes, John, what I see is people, I think, initially feel like, okay, I have these grants, I have these options. This is an investment decision. Or maybe they're adding another layer, or their primary concern is this is a tax decision. Both those absolutely come into play. There's a lot of details in the mechanics that you were touching on, those objectives, you know, liquidity and leverage and the tax implications. But I also think it's so important to, you know, those objectives, what are you trying to achieve? It's really, in my mind, it's a financial planning decision and tying it back to their personal goals. You'll hear a lot of external issues, you know, what analysts are saying about the company or the stock or the market. You'll be looking at the tax code. You'll be hearing the buzz up and down the hallway of what others are doing. But, you know, you got to look at this in the lens of, how does this apply to your goals and your timeline, you know, new home purchase or paying for college or retiring or philanthropy, and not just those hard type goals, but there's, you know, especially as we're seeing in markets like today, the softer side, right, John? What's the comfort level with volatility or risk? And for some people, that's hard maybe to put on paper, but it absolutely is a real driving factor as to what the objective is. Do we want to aim for the upside and accept more risk, or are we wanting to diversify and spread risk and hedge downside as quickly as possible?
So let's dive into it. Let's talk first about stock option strategies. Once again, kind of a matrix of different alternatives, and let's define some of the more advanced planning strategies as it pertains to restricted stock awards, now that we've already covered the fundamentals in an earlier call. So the three basic alternatives that an option holder has are either A, to simply do nothing, just wait, delay the decision. The second is to immediately exercise and sell as a way of cashing out. And the third is to exercise, but to not sell the underlying stock acquired. Let's go through those three. Number one, the reason I would delay and simply continue to hold them, maybe the option has a longer remaining life, and I want to give it more time to continue to appreciate and create more value for me. Maybe I believe that the shares are currently undervalued. That could be very well be the case today. If I'm an employee at a company where the stock is down temporarily, I want to wait for a market rebound before I go ahead and exercise. Number three, maybe I don't want to exercise today because I'm in the maximum marginal bracket. And we know that with an option exercise, the income is recognized in the year of exercise, not when it's originally given, not when the options vest, not when the shares are sold. It is my intentional act of exercising that triggers the tax bill. So there's some flexibility or control that the individual has to determine when it's most advantageous to exercise and to report the income. Maybe the client doesn't need the liquidity. And so therefore, there's no reason for me to exercise and sell. I'll continue to hold it. And then, of course, last but not least, maybe the amount of my exposure is something that I'm comfortable with, that I have a well-diversified portfolio in addition to the options I hold, and that exposure is not of concern. What about exercise and sell? For many clients, there are two dates that they most commonly exercise. The first date, of course, is as soon as they can. As soon as the options vest, it's like, okay, I'm going to take that money off the table and do something fun with it. Or for some, the procrastinators, the most common time at which they exercise is right before expiration. They have to do something before the options lapse. For those who choose to exercise and sell, they've got to be aware of some of the considerations. Do they have the available cash to exercise and then to pay the required taxes? What is the additional increase in income? What is the ramification of that? What kind of financial implications will that cause? And there are three basic triggers. There's nothing magical about these, Scott, But for those who are looking to exercise and sell, the question I would ask is, what's your strategy? Are you just going to kind of keep your fingers crossed? Are you going to pick an arbitrary price? There are three ways to begin to think about a strategy. One way is to do it on a time basis. Scott, I'm not going to try to predict the high point or low point in the stock price. I'm going to hold my options, but as I get closer to expiration, I am going to systematically, in a disciplined manner, peel off 25% per year in the last 4 years. I get the upfront leverage and growth, but then as I get closer to my expiration date, I'm beginning to reduce my exposure. The second way to go about it is to pick a price. Scott, maybe twice the initial grant value. Maybe that becomes a trigger. And every multiple thereof, that would automatically cause me to trigger a sale. And then the third way to think about it is based on taxes. So let's say hypothetically, last year my income was $175,000. That puts me in the 25% marginal bracket. I have $150,000 of additional income that I can recognize that year to still keep me in the 24% marginal bracket. So Scott, my decision on when and what to exercise is not based on time. It's not based on price. It's based on the intentional act of recognizing income at lower marginal rates to reduce the tax bite.
Exactly. You know, John, I love that. And I think, you know, we're often really using kind of a combination of those three trigger points. But I think it's very important, as in many areas of investment, easy to talk about hypothetically, right? Or to lay it out in papers, nod head, say, yes, yes, that makes sense. When you sort of get into the game, all right, and stock price is moving up or down, it's moving down a lot, or it's climbing and you think it's going to go higher, having a written plan outlining what you've just described there, a time-based strategy, target price points. I think that's important because it helps avoid moving the goalpost. You know, there's kind of tragic last words for option holders. You know, I'm just going to wait a little bit more, another 10%, another 10%. That can work, but you better know, you know, is that within your risk budget, so to speak? Are your other goals funded? Is that an acceptable level of risk? Because, you know, things can turn south very quickly, as we've seen, and it's very difficult to you know, to pull the trigger, so to speak, in the moment. And so having that predefined plan that we can go back to and say, well, you know, we had looked at this and this was the point. And there you know, maybe there really is some good reason. Maybe factors have changed that cause a different decision. But I like having that outlined ahead of time.
Good. Yeah, I like it too. The last approach, as opposed to simply do nothing or to exercise and immediately sell to cash out, is to exercise and then hold the acquired stock. And the reason somebody might do that is they want to exercise maybe right before expiration. They have to exercise, but they don't want to get out of the stock. They still think it has upside. They'll continue to hold it, maybe for price appreciation or maybe for dividends. Or maybe they're exercising not because they plan on selling, but they're exercising specifically to capture the income in a certain year. Or maybe they're exercising, because remember now, exercise triggers ordinary income tax. But if I exercise and then hold the stock for a 12-month period of time or longer, I can get capital gain treatment on those exercised shares. So that is the third basic approach. Do nothing, exercise and cash out, kind of a hybrid strategy where I exercise and hold. Here's another hybrid strategy, which is kind of splitting the baby in half. It's exercising and sell to cover. And so wait a minute, John, you're telling me that the stock may continue to appreciate, and boy, I'd love to be along for the ride, but I also don't want to run the risk that I hold this thing and find it dropping in value and my potential benefit goes to zero. How about this? How about if I exercise and I sell enough of the acquired stock to cover the cost of the exercise and the taxes? So now I'm playing with, and excuse the behavioral terminology, I'm playing with house money.
Right.
I exercised by using borrowed money or my own money. I acquired the stock. I sell enough of it, a portion of it, to cover the cost of exercise and the associated tax bill. And what I'm now holding, Scott, are free shares, shares that represent my net profit in the position. And maybe psychologically, I'm okay with the volatility, the up and down, the potential loss in value, because that's nothing I paid for. This is already profit to me,
Mhm.
maybe a greater profit or a smaller profit, but maybe that's volatility that I'm willing to accept. Let's talk about another strategy, and this is an exercise strategy. It's called stock swapping or pyramiding. As we know that when we exercise, we can either use our own cash or we can borrow from our broker dealer or a financial advisor. We can borrow from the institution the cost to exercise. Pyramiding or stock swapping is a process by which I use shares of existing stock that I own. That's my currency, not cash. I use the value of shares I own, and I pay the cost of exercise by turning those shares back to the company to cover that exercise cost. Now, the advantage in doing so is as follows. Number one, if I'm overly concentrated in the stock, this allows me, this kills two birds with one stone. It finances the exercise of my options, which I have to do at some point, and it reduces my exposure to the long shares that I already have. A lot of individuals, right or wrong, intentional or not, they've got a lot of exposure to company stock. And one of their challenges is what's the right amount? How much should I be comfortable with? How do I deal with this concentrated position?
Right.
So stock swapping or pyramiding is a way for us to use shares of stock to finance the cost of exercise, reducing our exposure and avoiding the capital gain that would have been incurred had I sold those shares in the open market. Another strategy is the 83B election. It's another tax-based or tax beneficial strategy. So we know that when we exercise our stock options after they vest, all of the growth is going to be taxable at ordinary income. 37%, Scott, plus 0.9 for families above 250. It's a big tax bill.
Mm-hmm.
There is a way around it, or there's a way to reduce that tax bill, but it comes at a risk. And that is called the 83B election, if the plan provides for it. What it requires is that the individual doesn't wait until vesting 3 or 4 years later. They go ahead and they make this election within 30 days of the grant. Now, let's assume that within 30 days, the stock hasn't moved a lot. I'm going to pay a minimal amount of tax now. I'm going to provide the upfront cost to exercise at that fixed price. And now I'm going to hold the shares until vesting 3 years or 4 years later. The hope is that I paid a small amount of tax up front and the shares appreciate so that when they vest and I sell them, I get capital gain treatment. We all like 20%, a lot more than we do 37. The risk, as I'm sure you can recognize, is that I went ahead, I exercised, I put my own money at risk. I paid a small amount of tax. The shares haven't vested yet. And within that 3-year period of time, the shares could fall dramatically, causing me to lose money in the process.
Yeah, very interesting strategy. When we talk about sometimes, but I think it's a key point. You're sort of raising your hand and volunteering to say, I'm going to pay the tax. I don't have to now. And I don't even, there's quite a bit at risk there in terms of what actually comes to fruition. So, sometimes you go through a similar type calculation, talking about something like maybe a Roth conversion. You're volunteering to pay tax now for a potential benefit down the road, but those are assets and dollars you own and control. This is could pay off handsomely for you, but it's kind of doing it on a hope and dream. It seems to me, John, is that I feel like I see that strategy more commonly discussed with maybe early phase technology companies where they're, the people are really looking for a rapid rise and.
Yeah, 83B, good point, Scott. Thanks for mentioning it. It's not universal. And so as you had referenced in the introductory remarks, you got to dig into the plan a little bit. And so get your advisor to help to understand the specifics of your plan, because they do vary from company to company. Some plans offer 83B, some don't. And so you've got to determine whether or not that's even an available strategy. But some companies have used it as a way of providing that tax advantage. Right. They use options as a form of compensation instead of cash. Some companies have moved away from it, Scott, because they now see the risk of it. So back in 2001, that technology bust that we saw, some companies used 83B. The employees got really excited about the opportunity to lower the tax bill, but then they suffered a significant financial loss when the stock went down. So there's both pros and cons to the 83B election. There's one other strategy we should discuss regarding options. And once again, we're focusing on option strategies now. We'll address some that are more pertinent to the restricted shares in a moment. It is something that we covered very briefly during the first call. We know that there are two types of employee stock options, Scott. There's the NSO variety. That's more commonly given. 90% of options are of the NSO variety, and the client simply pays ordinary income tax at vesting. I'm sorry, at exercise. Mm-hmm. The second form or flavor of stock options, less commonly used, is called the incentive stock option, or ISO. And the ISO works differently with a significant advantage. Instead of recognizing ordinary income when the option is exercised, the ISO produces no compensation income in the year of exercise. And if it's held for what's called a qualifying disposition period, 2 years from the date of grant, 1 year from the date of exercise, the gain when those shares are sold, client determines the timing at which they want to recognize the income. If they meet this qualifying disposition, they pay not ordinary income tax, but long-term capital gains.
Right.
And so that's another example of a strategy, a potential strategy that may provide a certain tax advantage. Option gifting, if the plan allows for it, another caveat, another potential consideration for the very wealthy who say, wait a minute, I understand that the exemption amount today is $12 million per person, but it's probably going to go down in a couple of years when the TCJA expires. How do I pass on more of my wealth to my beneficiaries? Mm-hmm. We all understand and recognize the benefit of gifting. Taking assets that I own today, using the annual gift exclusion, or maybe even my unified credit amount, and transferring the value of these assets from my ownership to those that I want to benefit. We know that transferring assets today provides an immediate estate tax reduction. But where the transfer or gifting strategy makes the most sense, where it provides the greatest benefit, is transferring not just the present value of the asset today, but an asset that maybe has a low value today, but can appreciate significantly after the transfer has taken place. And so let's think about this. I've got a $100,000 option award. It was made recently, and it's only worth $100,000 today. We know that options have a lot of leverage. We know that, Scott, over the next 5 or 10 years, this option can grow to be significantly worth more. And so I transfer that option using my annual gift amount, or maybe some of my unified credit amount. I transfer it today directly to my beneficiaries or to a trust. Mm-hmm. And in doing so, I pay a small amount of gift tax today in exchange for some tremendous estate tax saving leverage down the road when these options become worth a lot more. So option is another strategy.
Like a financial jack in the box, right? You're paying the tax on the small amount and you move it across that generational line or into another entity like the trust. And then the idea is there's the potential for that big hit to blow up on the other end. So, yeah.
Yeah, the whole idea is to have it accrue value, not while I own it, increasing the taxes I pay at my demise, but to have that large value accrue after it's already been transferred to my children outside of the estate or wealth transfer tax system.
Yeah. Maybe a quick question on that, John. Do you have a sense of how many companies are permitting gifting of non-qualified options?
It varies company to company. And unfortunately, what you got to do is read the plan agreement to determine whether or not it is even available. Some plans allow for it, some don't. Some have requirements. You can only give the shares to your spouses or direct lineal descendants. Others provide more flexibility, so it does vary from plan to plan. Let's now turn our attention to some advanced strategies on restricted stock. Once again, two primary forms of equity-based compensation. Options, which provide leverage if the shares go up in value, and then restricted stock, which provides not only upside potential, but also intrinsic value, right? An option only makes me money if the shares go up. If the shares are flat or go down, I make nothing from it. The restricted stock award that I receive, whether the shares are higher, lower, or the same, there's some value to the restricted stock award when it eventually vests. And like we had illustrated with the option position, we try to identify a number of potential strategies that solve for different objectives. certain strategies that make sense for clients who are looking to generate liquidity. They want that money to reinvest in other assets or to buy homes with. Other strategies that might hedge the downside without triggering a tax bill. Diversification strategies. How do I, remove the idiosyncratic risk of a single security and diversify into other asset classes? And then two other broad buckets: wealth transfer tax savings and income tax minimization. So let's dive into them. The first opportunity is a direct sale. Mm-hmm. And once again, I love what you mentioned earlier. Maybe that's the baseline case. Maybe I think about that. I'm not going to sell all my stock, but maybe I sell 25% per year over the next 4 years.
Right.
As a way of reducing my exposure gradually over time. The advantage of a sale is what? It immediately hedges my downside from the amount that's been sold. I can't suffer a decline in value if I have reduced the amount that I own. It provides me with liquidity for personal use or diversification. The downside is twofold. Number one, the stock may continue to appreciate, but I'm going to view that not as a negative occurrence. Once again, Scott, if you've advised me to sell 25%, mm-hmm. I don't necessarily want the stock to go down to validate that decision. I still hold 75% of the position.
That's right.
That's like a client who goes ahead and buys fire insurance on their home. And at the end of the year, they say, wait a minute, that was a waste of money. I wish my house had burned down.
There's no fire.
Because I would have collected money on the policy.
Right.
So.
Yeah, but I think that's, but it's also the flip side is, you'd really have to have great confidence that that single stock, if you hold it from restricted stock, is going to outperform a more diversified market basket. Certainly that can happen in any given period of time, but it becomes much less likely over long periods of time that we've seen, and quite a bit of specific company risk. We talked about that last time. It's some interesting points about the average stock in the S&P 500 has much greater volatility than the S&P 500 itself, as an example. So,
Scott, I think you hit the nail on the head. We can talk about returns, and that's where many investors, that's what they look at. Right. Is the stock I own, is it going to do well? Or is it going to do relatively well versus the basket or the other alternatives? Mm-hmm. I'm not sure that that's the right way to look at it. I think the way that we need to begin this conversation or examination is, what is the risk of a single stock position relative to a diversified basket? And if you want to talk about returns, I'm glad to do it. If I have all my money, hypothetically, in an energy stock, mm-hmm. well, for the last 10 years, what does that mean? It means that I didn't have any exposure to technology. Right. It means, by definition, I didn't have any exposure to healthcare. It means that, by definition, I may have missed other market opportunities, which would have not only reduced the security-specific risk, but maybe even provided greater return opportunities as well.
Absolutely. Absolutely. Yeah, there's a big difference between strategies or mindset that gives you the potential for building wealth rapidly. Very different than the strategies or tactics that give a high probability of maintaining and preserving wealth. And you need to be clear about that. And sometimes it's a mix, sometimes using that mental accounting. This 75% of my net worth is dedicated towards my high probability, high priority goals. And I want to make sure that's the don't screw it up money. And then maybe, with this portion, we're free to take on more risk and let things run. And because we're comfortable with the downside, but we've contained it and insulated it from the serious money that's going to, support our family's goals.
Love it. So for some people who are considering an outright sale, for certain individuals, there's something they need to be aware of. If they are a control person, an officer, a director, or a 10% owner, they are considered to be a control person or an affiliate. And they're governed under a couple of unique rules. One is called Rule 144, which requires certain filing with the SEC regarding their intention to sell. Another may involve the windows under which they can sell, where the company has restrictions because of their significant position and access to material non-public information. There may be some restrictions on what they can or cannot do with their shares. One way around those restrictions for those affected individuals is to use a 10b5-1 plan. Now, don't worry about it if it's not something that's germane to you, but for certain individuals, 10b5-1 plans are filed by the company, which affords their executives the opportunities to sell stock on a regular basis. without additional scrutiny, without increasing public awareness, without running afoul of SEC rules. 10b5-1 plans are systematic, regular, time-based plans to sell a percentage of stock as opposed to an individual's discretionary attempt to either to reduce or increase their exposure to the company shares. Let's talk about a strategy as opposed to the liquidity, which comes from an outright sale. Mm-hmm. What about the client who doesn't want to pay the capital gain tax today? The client wants to protect themselves, but they don't necessarily want to sell the stock and pay the capital gain tax. There's a strategy called a zero cost collar. And let me explain what that is. We're using options, call and put options. We're going to sell a call option at a price higher than today's market value. We're going to receive a premium for that option sale, and we're going to use that option sale and that premium to purchase a put. We all understand the basics of options. Calls benefit when the stock goes up, puts benefit when the stock goes down. We're using these two in concert to essentially create a band around the current stock price. So let's assume that my stock's trading at 100. I like it. I want to continue to hold it. Don't want to pay the capital gain, but I'm worried. What if some bad news comes out? What if the stock drops materially from 100? I don't want to see a large percentage of my net worth evaporate. I sell a call option at a higher price, $125, and I use the premium from that call option to purchase a put, maybe at $90. What I've essentially created are bands around the current stock price for a specified period of time. If the stock stays within that band, nothing's happened. I've created a hedge, haven't paid anything for it, and I retain my stock. If the stock goes up above 120, I have made a predetermined commitment to sell it at 120. Any advance above that number, I do not participate in. I'm willing to forego that because what I've received instead is downside protection.
Absolutely.
If the stock were to fall to 90, I am guaranteed to be able to get out of the stock at a minimum price of 90. So if the stock declines to 50 or to 30 or to 10, I've now got a minimum floor of $90 a share. That's a zero cost collar, Scott, which is primarily used for hedging purposes.
Really interesting strategy. I think you had as a downside, limits upside potential. Of course, if someone was very bullish on the stock and their outlook, they could just write the check to pay for the put. So essentially just buying the floor, right? Instead of selling the roof to pay for the floor, like in a collar. So you could just do it. I did just want to touch on earlier on one of your slides where you had the different methods of thinking about how to work out of option position or stock position, and you had price targets and targets above, which you said really like doing that, and below a stop. There is a material difference between putting in a stop loss order below a sell price. It sounds good, but it doesn't always work, does it, John, compared to buying a put where it's a contract. And so sometimes we talk about stops and say, nice idea, but when you have an extremely volatile day, that order might get filled well below the stop price where you're actually trying to protect the
in certain instances that could introduce significant downside risk, but I do like the general concept of the discussion, Scott.
Sure. Mm-hmm.
So look, how much downside am I willing to absorb? And everybody's got to answer that individually. And so based on that downside risk exposure that I'm willing to accept, what do I do to protect myself beyond that? Do I sell it outright? Do I hedge it with a collar? Am I willing to pay the premium required to buy insurance, i.e. buy a put? Do I try to protect myself by putting in a stop loss order? There are a variety of different ways that the client can address that.
Right.
With different ramifications. Let's continue on. Let's talk about another strategy, which is known as an exchange fund. Now, exchange funds have been around for a while. Some have argued that they might come under scrutiny, and because what they accomplish sounds almost too good to be true, Scott. And so we know that if we went ahead and we sold some of our concentrated position and then reinvested in a diversified portfolio that you might build for me, we know that along the way, of course, I've got to pay the capital gain on that stock sale. An exchange fund is a derivative instrument. It's run by a third-party sponsor. that accepts contributions of different stocks from different individuals. Let's hypothetically assume it's 30 different stocks, 30 different individuals who all have the same goal in mind of diversifying their exposure from a single stock into a diversified basket of holdings, and to do so without realizing current capital gains. So exchange funds are private placements looking to achieve a diversification of exposure by receiving securities or contributions from many different investors across different companies or sectors. These are generally only available to sophisticated investors, those who are described to be as accredited investors under SEC 501. You've got to have a minimum net worth or income level in order to participate. The minimum for most of these is $1 million participation level. And generally speaking, they come with a minimum commitment of 7 years. So you've got to be willing to accept those terms. Obviously, an individual who has a $10 million exposure is not going to commit $10 million to an exchange fund. That would be very limiting. But maybe it makes sense for a portion of the exposure to achieve diversification without recognizing the tax consequences in doing so.
Yeah, very interesting strategy. The diversification might be a little bit different than how we, I think, commonly might think about it, right, John? I mean, if we're to start with a clean piece of paper and say, how do we want to build a portfolio? I mean, the diversification in the exchange fund is, you know, a bunch of people contributing their concentrated positions. And so you're kind of ending up as part owner of that basket of securities that are contributed, right? So, I mean, you could run the risk of technology sectors had a fantastic 5-year run. You're in an exchange fund, you love it, you're diversifying your pool without recognizing tax, but really what you've done is contributed into something that largely looks like a tech stock fund, and then 2020 comes and there's a drop. Am I right on that, or are they doing more?
You are. So you've got to you got to do some due diligence. Yeah, you got to do some due diligence or research on the fund that you're participating in. Some of them are existing funds that may have a mandate or an objective, S&P 500 replication. And so if that fits for you, that's great. Or others are small cap oriented. Yeah. Or others might be sector oriented. So you got to do some research to find out not just what am I reducing from my contribution, what risk am I now avoiding, but what new risks am I now assuming given the exposure of the fund that I've decided to join. Here's a good illustration of it, Scott.
Yeah, that's great.
My client holds shares of ABC. What an interesting name I came up with. First 3 letters I could think of, ABC.
Love that company. Yeah.
There you go.
They're doing great stuff.
So the client bought the stock for $100,000. It's worth $1 million today. So there's a rather substantial gain. The client wants to diversify because diversification helps to reduce risk exposure. But I don't want to sell the stock and pay the capital gain at 900. So I go ahead and I contribute my shares. I put them into the fund. And what I now own for the $1 million contribution is not $1 million of ABC. I own a $1 million slice of a much larger pizza pie. And that slice has exposure to, in my example, 12 different companies. Energy companies, technology companies, healthcare companies, communication companies, banking companies, entertainment companies. And so I have diversified my $1 million exposure from a single stock in a single sector to a $1 million exposure to a diversified pie of different assets. Now, 7 years later, when I want out, Scott, I make what's called the withdrawal subscription. And I write a letter to the company that constructed this exchange fund. Now, these are not actively managed. They are constructed as they select different securities to go in to create an overall portfolio exposure that they deem to be acceptable. But there's no ongoing management where they're deciding, oh gosh, Apple should be sold today and Hewlett Packard should be bought. There is an upfront selection process upon contribution, but no active or ongoing management. 7 years later, I want out. And I tell the fund sponsor, pay me out, not in cash, but in securities. I can ask for my original stock back. I can ask for stocks other than what I originally contributed. It's probably the case because I already have enough of the former. But it's ultimately up to the plan sponsor to decide exactly what that distribution will look like. So there are a couple of caveats. Number one, 7-year hold. Number two, upfront placement fee of 1% of my contributed amount. Number three, blind acceptance that I'm going to be contributing or participating in a fund that I'm not necessarily controlling. Thirdly, I've got to accept the idea that I'm going to be in it for 7 years and that when I get out, it's going to be the plan sponsor that determines not the amount of what I get. So my amount is going to be determined based on the performance of the fund,
right?
But the way in which I'm paid out as I withdraw. Let's see. Let's continue on. Let's talk about one other item. Let's talk about gifting. We mentioned the idea of gifting when we talked about options. It makes a lot of sense with restricted stock. I find that one of the most underutilized strategies. Look, there are a couple of freebies the IRS gives you. And I know that saving dollars in taxes is just as valuable as earning an extra dollar from investment return. And so I am attentive to both. I concentrate on both. I understand that dollar is fungible. I don't really care whether I earned it because of a successful investment or I earned it because I was, aware and saved taxes. There are a couple of freebies in the tax code. Let's go through them. Number one of the opportunities is Roth. The idea to grow money inside an account that's never taxed. Number two is 529 plans. If I'm going to put money aside for education purposes, I'd rather do it in an account where it's not taxed versus one where it is. Third is a donor advised fund. Donor advised funds allow me to contribute to charity in a more tax efficient manner, not to give away more money, but to save more money through the giving that I'm already doing. And another opportunity, of course, is through annual gifting. It's 15 or 16,000 bucks per year now. It was 15, it went up. It's $16,000 per person per year. And as we were talking about earlier, Scott, whenever I'm trying to pursue a particular financial objective, I kind of like to start with the most basic and fundamental. Maybe that solves my benefit or purpose. Maybe it doesn't. And I need to move on to other strategies that would complement it. But annual gifting is a real easy one. There's no cost in doing it. I transfer the asset to my beneficiaries. The growth accrues outside the taxable. I pay no taxes for the transfer that is affected. It provides a lot of benefit. And so it's use it or lose it on an annual basis.
I think you said a key point there, John. You transfer the asset. Okay. So a lot of people think, oh, I could make a gift to family. I could make a gift to charity. Both wonderful things. They start reaching for the checkbook. And we're often saying, whoa, whoa, whoa. Let's look up and down the balance sheet here and see if there's some asset that you hold that has gone up in value that really has a tax liability attached to it, for you as Gen 1 or however you might consider it, and see if you can gift the asset instead of writing the check. Doesn't always work, but it often does, right?
Right. Absolutely.
In a case like today, maybe there's an asset that's gone down in value and there's a capital loss, and there's the opportunity to sell that and book a capital loss for yourself and then write the check off that amount instead of that very hard to come by dollars in the checkbook that have gone through the tortured tax wringer to get there.
Absolutely. And so for clients who are looking to utilize gifting directly to family, the $15,000 or $16,000 exclusion per recipient. And by the way, think about that leverage, Scott. You've got a wealthy grandparent, and they've got children who are then married and then grandchildren in this family tree. I can give $16,000 per person to my son and his wife, to my daughter and her husband, and to all their children. And I can do the $16,000 and my wife can do the $16,000. Now think about the leverage and how much of my wealth I can transfer down to the beneficiaries that I want to recognize.
Yeah. Hey, John, just yesterday afternoon, we had a great meeting with a longtime client who's done very well. And so, there's obviously financial and tax benefits that we're talking about here with gifting, but we spent a lot of time talking about gifting in terms of starting to build financial acumen and financial skill set. Of course, providing dollars that could help with important things like getting going in life and college and buying that first home, and getting money to younger generations when they could really use it early on. And the person making the gift getting to see them enjoying it, that's wonderful. But really the idea of that we were discussing a lot yesterday is training wheels and building up some financial skill set. And there again, not just theoretical on paper, but having dollars in their name in hand through rough market years and maintaining discipline and seeing it grow over time to start building that skill set. So it's not just a large, inheritance that comes when they're well into middle age or beyond, way down the road. And so I think there's more than always just the financial side of this as well, of course.
No doubt. No doubt. Good stuff. So when we're talking about gifting, Scott, the first gifting strategy that we've discussed is gifting the family. But I know that a lot of our clients are giving money to charity. And so what I'm going to discuss now is this concept of not only managing my option or restricted stock position or my charitable giving. I'm not going to look at these functions independently. Right. I'm going to look at them collectively. To try to determine whether or not I can continue to engage in things that I'm already doing, and if I can do so with an additional benefit. And so annual giving is something that a lot of us do to the charities that we want to support. In fact, last year, $484 billion was given to charity in the US, largest number on record. Clients feel wealthier today because of the stock market returns, at least up until recently, and their real estate values had gone up. They want to give back, and in fact, they know that the itemized deductions that are still available today in the tax code are much more limited. Let's discuss those very quickly. I get 7.5%. I get a medical deduction, but I only get that deduction if it exceeds 7.5% of my AGI. Not a lot of clients are able to benefit from that. I get mortgage interest deduction, but only if I have a mortgage and only if I itemize. I get SALT taxes, but as you know, and your poor friends up in the great state of Minnesota, it's capped at 10.
Yeah, it's pretty low.
And so the charitable gift is another itemized deduction available to me. And so I want to do my charitable giving. I'm already doing it, but I want to do it in a manner that produces the greatest advantage, the greatest value to me. I want to give when I can exceed that standard deduction, so I maximize the tax benefit. I want to do it in years when my marginal bracket is highest to amplify that benefit. And what I want to do, and I know that you've heard this terminology before, is I want to give by bunching my deductions. Instead of giving a small amount every year that may or may not provide a tax benefit, I want to make a larger gift in a single calendar year to exceed the standard amount and to amplify the tax benefit. I'm not giving away any more money than I was planning on giving. I'm just trying to maximize the tax advantage that I gain from that giving. And so here's an example, and we'll end with this. This is the idea of bunching. And I can bunch by making a large upfront gift of an asset to an entity directly, or maybe the more effective way is to establish a donor advised fund where I make the gift in a single calendar year for the associated benefits, even though my distributions from it may occur for years to come to different charities. So let's look at a client who's giving away $25,000 per year, maybe to their church or favorite charity. And so up top, you can see this client has $10,000 of state taxes that they get as a deduction, no mortgage, and they're giving away $25,000 per year. So their total itemized deduction in each of these 4 years, Scott, is $35,000. We know that the standard deduction is $25,000. And so the itemized amount in each of these 4 years exceeds that. The client is going to claim the larger itemized deduction of $35,000 per year in the 4 years illustrated. The total amount of the deduction available to the client is $140,000. Now do me a favor, go to the bottom of the page. This is a client who gives away the same amount of money, but does so more intentionally, more strategically to derive a greater benefit. This client still has the $10,000 state and local tax deduction each year, no mortgage interest, but instead of giving $25,000 each year, this client has bunched their giving into 2 years. Same total of $100,000, but look at what happens. In the first year, the client enjoys more, $25,900 of the standard deduction. And in the second year, because they've given a larger amount, has a much larger itemized deduction of $60,000. The same pattern is repeated in 2024 and in 2025, the same $100,000 of giving over 4 years, but it produced an incremental benefit to this client of $31,800. Now, the leverage or the application here is not just the tax advantage through this intentional giving, but I give appreciated property. I give some of the restricted stock that I've acquired. And that allows me to avoid the capital gain tax and the increase in my AGI. The money grows tax-free inside my donor advised fund. I killed two birds with one stone, producing an even greater benefit to the client.
Yeah, this is great. And this is really, I think we're both, maybe kind of smiling because this is just the beginning of a really exciting area, right? Giving away and thinking about the bunching with the restricted stock or the stock options or the concentrated stock, the donor advised fund you mentioned is a great one. And we're getting to the top of the hour, probably don't really have any time to hardly go into it, but charitable trust for larger dollar amounts can be wonderfully powerful tools. Charitable lead trust, charitable remainder trust. We had some clients who had sold a business last year and had come in and were facing a large tax bill, and it was fun to actually get to pull the rabbit out of the hat on one of these and go with charitable lead trust and come up with a 7-figure tax savings and really help them benefit some of their favorite charities over a period of time. And so when they work, it can work very well. But that's great. Is there anything else you wanted to touch on before we sign off, John? Yeah.
No, thank you.
Once again, thank you. Thanks for coming. Really appreciate you partnering with us on this, and as always being a great resource, and one of the first guys that comes to mind when I have one of the tough questions, or I just want some another voice of wisdom and experience to bounce ideas off of. So can't thank you enough. This has been great. And again, for folks listening, general overview, seek your own information, feel free to give me a call at the office. So thank you, John. Take care.
Thanks, Scott. It was great working with you.
Likewise.